We're looking for a contraction of around minus 1.1%. So I think that's slightly more negative than consensus. The point here is, though, how much is priced in? We know that Q1 was weak. The Fed have told us all about this. The Fed have downplayed it, and they believe it was seasonal factors, that it was a West Coast port strike, bad weather, etc., and that growth will rebound. So I think markets aren't going to react too negatively unless we really see a disastrous outcome today on GDP. But we know, it's going to be negative.
Going to be negative. Okay, but pretty much priced in is what you're saying. Now, ahead of this second read on Q1 GDP, and over the last, let's say, I don't know, 3-4 days, maybe even a week, a trading week or so, we've had some pretty positive data, have we not? On the inflation side, on the consumer sentiment side, on housing starts as well, new home sales. That's looking pretty good. Do you believe what Janet Yellen is saying then? Her take, which is, look, Q1, don't worry about it. It's aberrational. It's all the reasons you mentioned. We're going to get back. We're going to see a Q2 rebound.
Absolutely. I mean, that's Barclays' view. We believe that it is a soft Q1, but we will see a rebound. In particular, Q3 numbers always look quite good in each year. And I think this rebound that we're going to see in the coming months is already taking shape. I mean, how much can you deliver negative surprises? We had a lot of negative surprises on US growth in Q1. The numbers, as you say, have started to deliver positive surprises. We believe that will be sufficient for the Fed to hike rates around September this year.
Okay, so baking in or pricing in your part of this consensus around a September liftoff date. What about, though, hanging over a Q2 rebound? What about inventory overhang? What about the capex cycle? Where on earth is that?
It's a good point. I think we will still need to see, certainly on the capex side of things, that that investment spending starts picking up and showing more sustainable signs of growth. Because for the longer term, for US growth, you need to see a pickup in capex. Even if we see a rebound in Q2, Q3, that may not be sustainable unless you see that spending.
And the irony is, isn't strong dollar or stronger dollar going to hurt?
It does to an extent, but the reality is that it's not hurt as much as perhaps, obviously it's had some impact, but not as much as it could have done. If we do see the dollar strengthening here, it is because the US will look much better than other economies. I don't, you could argue that a stronger dollar will start dampening that US growth outperformance, but I think you need to see a really substantial rally in the dollar for that to take place. And I think, where we do see the dollar rallying is mainly against the G10 currencies. Certainly the euro is where we do see much more downside pressure.
More downside pressure. Interesting here, because, I mean, a lot of chatter overnight and mixed messages, depending who you listen to, the Greeks or the other side, right, on whether or not we're going to get a default, what happens June 5th, etc. I wonder how much of this is moot, because the IMF has given the Greeks an extension, 3 weeks, right? By the way, you've got until, say, the end of next month. Doesn't that render this question of $300 million by June 5th, and if you don't pay a default, doesn't that render that whole issue moot?
Well, the problem is that that's just the first payment that needs to be done. And clearly there's a lot more going forward. I think 1.7 billion going forward in the next several weeks. And I think, yes, this is the key that everyone's looking at. But, there's a long way to go here. An agreement needs to be reached ASAP for this to be sorted out. That Greece doesn't default. We don't see a Grexit, and ultimately Greece's own debt position becomes more sustainable. So, yes, to an extent, it may not be a big issue next week, but I think markets are still focusing very much on that payment.
Okay, and when I think about the US and Japan, it's not apples, it's apples and oranges, clearly, right? But I'm starting to see worrying parallels here. In both cases, the labor market has improved. It is, in fact, tightening, right? But it's not filtering through to consumer consumption and spending. And of course, inflation is going different ways in each side, right? But at the end of the day, is it down to wages? Wages are still not growing strongly enough or fast enough to give people enough comfort money to spend.
That's true. I think a lot of it does depend on wages. Certainly in Japan, it's been, in our view, a key to really sustainable lift-off in inflation, to achieving this target of 2%. And clearly the weaker yen has helped to some extent, but the yen, how weak can it go? It's already very, very weak. We've had some pressure this week on the yen, but you need to see some real lift-off in wages, which happened for a short while, but now again it's starting to look a bit more lackluster.